Something happened in the global bond markets over the past 6 months that has veteran traders using a word they rarely speak aloud: panic. Not the visible kind with people running and shouting, the quiet kind. The kind that shows up in stressed phone calls between Treasury secretaries and central bank governors at 2 a.m. The kind that makes 40-year market veterans check their positions 3 times before going to bed. China has been selling U.S. Treasury bonds, not slowly, not gradually, but in massive sustained waves that have removed over $720 billion from the market since early 2022. And in just the past 6 months, the pace has accelerated to levels that are triggering alarm bells across every major financial institution in the world. Now, you might think, so what? Countries buy and sell bonds all the time, markets adjust, life goes on. But here's what makes this different. Here's why bond traders who've seen every crisis since Black Monday in 1987 are saying privately that this is the most dangerous configuration they've ever witnessed. Because China isn't just selling. They're selling into a market that's already fragile, already over-leveraged, already teetering on the edge of something that could make 2008 look like a practice run. Let me show you exactly what's happening, because the mechanics are terrifying and the implications reach into every corner of the American economy. And I should warn you, once you understand how precarious the bond market has become and what China's actions are doing to it, you'll realize why the Treasury Department is far more worried than they're letting on publicly. Here's the foundation you need to understand. The U.S. Treasury bond market is the largest, most important financial market in the world. Over $27 trillion in outstanding securities. It's the bedrock of global finance. Treasury yields determine mortgage rates, corporate borrowing costs, student loan rates, everything. The bond market is the price of money itself. For decades, that market functioned smoothly because there was consistent, reliable demand. Foreign central banks, especially China and Japan, bought enormous quantities of treasuries. They had to. Trade surpluses and dollar reserves needed to be invested somewhere. Treasuries were the safest, most liquid option. China accumulated over $1.3 trillion in U.S. treasuries by 2013. They were the largest foreign holder of American debt. Every month, like clockwork, Chinese purchases absorbed billions in new treasury issuance. The market could rely on that demand. It was structural, automatic, guaranteed. But that era is over, and what's replacing it is something far more dangerous. China's treasury holdings have fallen from $1.3 trillion to less than $775 billion today. That's over $525 billion sold in roughly a decade. But here's the crucial detail that's causing panic. The selling has accelerated dramatically. In the past 18 months alone, China has dumped nearly $200 billion in treasuries. The pace is increasing, not decreasing, and there's no sign it's stopping. Why is China selling? The reasons are multiple, and they're all structural, which means this isn't temporary. First, China's trade surplus with the United States has shrunk. They're accumulating fewer dollars that need to be recycled into treasuries. Second, they're using dollar reserves to support their weakening currency. The yuan has been under pressure, and China needs dollars to intervene in currency markets. Third, they're diversifying away from dollar assets deliberately as part of their de-dollarization strategy. And fourth, here's the one nobody wants to say out loud. They're preparing for potential conflict over Taiwan. If war comes, the United States would freeze Chinese holdings of treasuries just like they froze Russian assets. China is reducing that vulnerability now while they still can. These aren't temporary factors. These are permanent structural shifts. China isn't going to suddenly start buying massive quantities of treasuries again. That era is finished. Now, normally markets would adjust, prices would fall, yields would rise until other buyers stepped in. That's how markets work. Supply and demand find equilibrium. But here's where the 1987 comparison becomes chillingly relevant, because the Treasury market isn't normal right now. It's over-leveraged, illiquid, and fragile in ways it hasn't been since the crash that nearly destroyed the global financial system 38 years ago. Let me explain what's happening in the market structure itself, because this is where the real danger lies. Treasury markets used to be dominated by traditional buyers: banks, insurance companies, pension funds, foreign central banks. They'd buy bonds and hold them. Simple. But over the past 15 years, the market has changed fundamentally. Now it's dominated by what are called basis trades and leveraged arbitrage strategies. Here's how a basis trade works. A hedge fund borrows money, uses that borrowed money to buy Treasury bonds, and simultaneously sells Treasury futures contracts. The tiny price difference between the bond and the future, maybe 0.1%, becomes profit when amplified by massive leverage. A fund might use $1 billion in capital to control $50 billion in positions. 50 to 1 leverage. When the market is calm, this works beautifully. Free money. But when volatility hits, when prices start moving unexpectedly, when China dumps $720 billion in bonds, these trades blow up. The leverage that amplified profits amplifies losses. Funds face margin calls. They're forced to sell everything simultaneously. And because everyone is running the same strategy, everyone sells at once. This is exactly what happened in March 2020 during the COVID panic. Treasury markets, supposedly the safest in the world, froze completely. Nobody would buy. Prices were in free fall. The Federal Reserve had to intervene with unlimited buying to prevent total collapse. They created over $3 trillion in a matter of weeks just to keep the market functioning. And here's the terrifying part. The leverage in the system today is worse than it was in March 2020, according to estimates from the Office of Financial Research. Basis trade positions in Treasury markets exceed $650 billion. That's $650 billion in highly leveraged bets that become unstable the moment volatility spikes. China selling $720 billion creates exactly the kind of volatility that triggers these explosions. And unlike 2020, the Federal Reserve's ability to intervene is constrained. Inflation is still above target. Interest rates are elevated. The Fed can't just print unlimited money to stabilize markets without triggering an inflation crisis. They're trapped, and China knows it. Let me tell you about a conversation I had with a Treasury market maker, someone who's been in this business for 30 years. He described the current situation like this. Imagine a bridge, thousands of cars crossing every day, but the bridge has cracks, deep structural cracks. China selling is like removing support beams. Each beam removed, the bridge gets weaker. We don't know which beam is the one that causes collapse. We just know we're removing them one after another, and the bridge is shaking. That's where we are. The Treasury market is shaking, and the people whose job is to keep it stable are running out of options. Here's what makes this the most dangerous phase since 1987. In October 1987, markets crashed because of a combination of leverage, automated trading, and a loss of liquidity. The Dow Jones fell 22% in a single day, but the crisis was contained to stock markets. The Treasury market remained stable, actually serving as a safe haven where investors fled. Now, imagine a crisis where the Treasury market itself is the problem, where the safest asset in the world becomes unstable, where there's no safe haven to flee to. That's the scenario we're facing, and China's selling is pushing us toward that edge. The $720 billion isn't just about supply and demand. It's about confidence. It's about the psychology of markets. If the world starts to believe that Treasury bonds aren't safe, that even U.S. government debt is risky, then the entire financial system has no anchor. Everything becomes speculation. Nothing is stable. And we're seeing early warning signs that confidence is cracking. Treasury auctions are showing weaker demand. Bid-to-cover ratios are declining. Dealers are having to absorb larger portions of new issuance because other buyers aren't stepping up. Yield volatility is increasing. These are the tremors before the earthquake. Let me give you the human dimension of what this means, because bond market instability isn't abstract. It affects everyone. There's a couple in Arizona planning to buy their first home. They've saved for years. They're pre-approved for a mortgage at 6.8%. But if Treasury yields spike because of market instability, mortgage rates could jump to 8% or 9% or higher. Suddenly, the house they could afford becomes unaffordable. Their dream is postponed or destroyed, not because of anything they did, but because China is selling bonds and the market is unstable. Or consider a retiree in Florida living on a fixed pension. That pension fund is heavily invested in bonds. If the Treasury market crashes, if bond prices collapse, the pension fund loses value. Benefits could be cut. Her retirement security, earned through decades of work, evaporates because of financial instability she doesn't understand and can't control. Or think about the federal government itself. They need to borrow trillions every year to fund operations. If Treasury yields spike from 4.5% to 6% or 7%, interest costs explode. The government would be paying an additional $500 billion or more per year just in interest. That money comes from somewhere. Social Security cuts, Medicare reductions, defense spending slashed, or alternatively, the Fed prints money, triggering inflation that destroys savings and crushes the poor. These aren't hypothetical scenarios. These are the direct consequences of Treasury market instability. And China's $720 billion shockwave is pushing us toward exactly that instability. Now, the optimists will tell you the market can absorb this. Other buyers will step in. Domestic demand will increase. Yields will adjust and find equilibrium. Everything will be fine. But the optimists said the same thing in 2007 about subprime mortgages. They said the same thing in 1987 about portfolio insurance. They said the same thing in 1929 about stock market leverage. Markets don't always adjust smoothly. Sometimes they break violently. And the conditions for a violent break are present now in ways they haven't been since 1987. Massive leverage, illiquid markets dominated by similar trading strategies, structural selling pressure from a major player, a central bank with limited ability to intervene, political dysfunction preventing fiscal solutions. Each element alone is manageable. Together, they create the possibility of cascading failure. And cascading failure in the Treasury market would be catastrophic beyond anything we've experienced in modern times. Here's what keeps me awake at night. The trigger could be anything: a geopolitical shock, a major hedge fund failure, an unexpectedly weak auction, China announcing accelerated selling. Once confidence breaks, once the market starts to freeze, the mechanisms that are supposed to provide stability, the market makers, the arbitrageurs, the automatic systems, they all fail simultaneously. We saw it in March 2020. The Treasury market, the deepest, most liquid market in the world, completely froze. Trading stopped. Prices didn't make sense. The only thing that saved us was the Fed's unlimited intervention. But they had near zero interest rates and no inflation constraints. They could print unlimited money without consequences. Today they can't. Inflation is still above 3%. Interest rates are at 5.5%. If they print trillions to save the bond market, they risk an inflation spiral. If they don't, they risk market collapse. They're trapped between two catastrophic outcomes with no good options. This is what China has triggered, not intentionally perhaps. They're responding to their own imperatives, but intentional or not, the effect is the same. They've created a $720 billion shockwave in a market that's already fragile, already over-leveraged, already vulnerable. And the shockwave is still propagating through the system. We haven't seen the full impact yet. It's like an earthquake where the initial tremor is followed by aftershocks, each one potentially more destructive than the last. Treasury market analysts are watching for specific warning signs. If 10-year yields spike above 5.5% without corresponding inflation increases, if auction bid-to-cover ratios fall below 2.0 consistently, if the Treasury euro-dollar spread widens beyond 100 basis points, if repo markets show stress with rates spiking above Fed targets, these are the indicators that instability is becoming crisis. And we're getting close to several of these thresholds now. Not there yet, but close, uncomfortably close. Let me give you the historical perspective I've developed from studying financial crises across decades. Every major crisis follows a similar pattern. Years of leverage building up, years of complacency, then a shock, something unexpected that exposes the hidden fragilities, and suddenly what seemed stable reveals itself as dangerously unstable. The shock in 1987 was portfolio insurance creating automated selling. The shock in 2008 was subprime defaults revealing hidden leverage. The shock now is China's selling revealing Treasury market fragility. And just like previous crises, The warning signs are there for those willing to see them. Rising leverage, declining liquidity, unusual market behavior, veteran traders feeling uneasy, the tremors before the earthquake. I'm not predicting certain collapse. I don't have a crystal ball. Maybe the market absorbs China's selling. Maybe domestic demand increases, maybe nothing happens, but I can tell you the conditions are more dangerous than at any time since 1987. The leverage is higher, the fragility is greater, the policy options are more limited, and a major player, China, is actively removing $720 billion from a market that can't easily absorb that shock. The Treasury market is entering its most dangerous phase in nearly 40 years. Not because of economic fundamentals, not because of inflation or recession or fiscal policy, but because the market structure itself has become unstable and a major source of demand has become a major source of supply. China has triggered a shockwave. That shockwave is propagating through the most important financial market in the world, and we don't know if the market structure can withstand it. The bridge is shaking, the support beams are being removed, and everyone who understands the situation is holding their breath, hoping the bridge doesn't fall, but preparing for the possibility that it might, because if the Treasury market breaks, if the bedrock of global finance becomes unstable, then everything built on top of it, the entire edifice of modern finance, becomes questionable. And that's not a crisis, that's a catastrophe. China just triggered a $720 billion shockwave. The U.S. bond market is entering its most dangerous phase since 1987, and we're about to find out if the system is strong enough to withstand it, or if decades of leverage and complacency have created vulnerabilities that even the world's largest, most important market can't overcome. The answer is coming, whether we're ready for it or not.